Credit cards aren't broken because interest rates are high. They're broken because they've been forced to do two incompatible jobs at the same time. They were designed to give everyone access to liquidity while pretending that risk doesn't have a price tag. That illusion is ending. When the proposal for a 10% cap on credit card interest rates hit the headlines, the debate split instantly. One side called the banks greedy. The other said price controls would destroy the economy. Both sides are missing the real story. This isn't about punishment or generosity. It's about the collapse of a hidden engine that has powered the American consumer for 40 years. For decades, the credit card industry ran on a quiet subsidy. Prime borrowers, the high-income, high credit score tier, receive the benefits: points, miles, 0% intro periods, and grace periods. Riskier borrowers paid for them through 25% interest rates, late fees, and penalty pricing. The system only stayed stable as long as that subsidy remained invisible. But today, the average credit card rate is hovering above 20%, according to the Federal Reserve. When the cost of living becomes a political firestorm, the math stops being invisible. And once a model becomes political, the model dies. Here is the uncomfortable truth. There was never such a thing as cheap credit for everyone. There was cheap access for the winners and predatory pricing for the rest. The moment you try to make credit fair by capping the price, the math of access falls apart. If a 10% cap ever becomes reality, banks won't just take a haircut. They will take an axe to their customer list. Riskier borrowers won't get cheaper credit. They will get zero credit. Credit limits will be slashed. Minimum payments will rise. Rewards programs will be gutted. Annual fees will come back. The cost doesn't disappear. It just gets repackaged. And the group that will be hit the hardest isn't only subprime borrowers. It's middle-income families who rely on credit as a bridge. They're about to find that bridge has been pulled up. This is why the panic is loudest among mass-market lenders like Capital One, Synchrony, and Bread Financial. These aren't Wall Street trading desks. They are the plumbing of the American mall. For them, high APRs aren't excess profit. They are the insurance premium required to keep access open. Remove the premium, and you close the doors. But here's the deeper shift most people are missing. Even without a new law, the era of the universal credit card is ending. Banks no longer need consumer credit to drive profits. They can earn returns in private credit, payments, and fee-based fintech with far less political exposure. When forced to choose between social access and profit margins, banks will choose margins every time. That's not ideology, that's arithmetic. What replaces the credit card isn't fairness, it's fragmentation. The most credit-worthy consumers keep their cards just with fewer perks. Everyone else gets pushed into the shadow credit market. Buy now, pay later plans and installment loans. These products are the new invisible debt. Costs are buried in fees. Penalties live outside traditional APRs. And many offer no real path to building long-term credit. Same economic burden, less transparency, a deeper trap. So this isn't a victory for consumers. It's the end of pretending that credit was ever free without someone else paying for it. A broken model can no longer hide its trade-offs. You can have broad access, or you can have capped prices, but you cannot have both. The cost of credit never disappears. It only changes shape. So here's the real question. Would you rather have expensive credit you can see or free-looking credit with the costs hidden in the fine print? Drop your take in the comments. This is Global Notes by JP. If you found this helpful, comment, like, share, and hit the bell. We're building the strongest macro community on the platform, one signal at a time, together.